Welcome back, everyone. Michael here with Offshore Citizen. Now, over the last couple of years, something has happened that a lot of people might have predicted would result in higher taxes. And that is, of course, governments have spent like crazy. They've had lots of different added healthcare expenses. They've gone massively into debt. And the consequence of this is some people have said that, look, taxes are going to be going up. And we've seen the signs of this. It started with, I think probably the first one was UK in their budget, where they said they're raising their corporate tax rate from 19% to 25%, and there's other places as well. Well, today we have some breaking news of the update of Malaysia doing this. So I'm going to talk to you a little bit about, first of all, Malaysia, but also about what you can expect globally and what it might mean in terms of places you should be looking at that are probably more likely to be competitive over the next little while. And so we're going to dive into that. Before we do, if you would like help with these subjects that we deal with here on the Offshore Citizen channel, please reach out to me. You can book a call, calendly.com/Michael-Rosmer, link in the description below, or send a message to our websites, offshorecitizen.net, offshorecapitalist.com. We can help you with international tax optimization, asset protection, forming companies, opening bank accounts, getting residency permits, citizenships, etc. And if you are not already subscribed, please hit the subscribe button. Really appreciate your support. Let's dive in. Okay, so in terms of what the announcement is in Malaysia, they're doing a variety of different changes, but we're going to focus on two main ones that could be relevant to a lot of people who are interested in relocating to Malaysia or maybe are already in Malaysia. The first may not affect many people. This is for companies who are earning what they call a one-time windfall tax. There's been talks about this in some other places as well, of having like one big tax to pay for the expenses of the past whatever period of time. In this case, Malaysia's normal corporate tax rate is 24%. They are going to tax, first of all, everything over 100 million Malaysian ringgit, which is about 24 million US dollars at this point in time, at 33%. It's a 9% increase. So that's not good for those people, but of course not so many people are likely to be affected by it. So it's probably how they can run down the list. The second thing they're doing, though, which is a little bit more significant, is normally Malaysia has a territorial tax system, so they don't tax foreign earnings. Now, the challenge with this is Malaysia also doesn't define what foreign earnings are in their statutes, and so it makes it a little bit complicated to figure out. This being said, they've decided to tax foreign earnings in this, so not so great. The second thing, which is a little bit more concerning, is there's a lot of people who have moved to Malaysia and said, okay, great, we're going to get our residency there, we're going to live there, it's a fairly tax favorable place. There's a variety of reasons for that, but one of them is the territoriality of their tax system. And they're saying they're going to tax foreign income. So that's not good for a bunch of people. Where this becomes a little bit tricky and unclear is at the moment, Malaysia doesn't tax dividends or capital gains, period. So it's not about foreign or domestic. They have something called the single imputation system, which also Hong Kong and Singapore both have, which means that if money, it doesn't get taxed at the personal level because the idea is it's taxed at the corporate level. The question in this case that some people are asking is, well, what happens if you receive foreign dividends now? Will those be subject to tax? If you look at the precedent in Singapore, they have some rules around what needs to have happened in order for those dividends not to be taxed. Sometimes they are, sometimes they aren't. Malaysia hasn't made statements on this yet at this point in time. These are some things that are unclear. And there's a decent chance that they may continue along that path, but there's also some chance that, being as the direction they've been going down, that could cause issues. Now, it's worth understanding that at this point in time, if they don't tax the foreign dividends and capital gains, realistically for most of our clients, it doesn't make that big a difference, because I've never advocated having a Malaysia normal resident company for anything but Malaysia local work where you'd actually have an office in excess of what you could do in Labuan. It's kind of bureaucratic, it's a little bit of a pain in the ass to have a Malaysian company, so typically hasn't been a great option. Usually we would go with a Labuan company. Again, I mentioned in some previous videos, Labuan's gotten tougher, but had much more favorable rules. And then domestically, if you needed to exceed the 4 people you were allowed to have at a marketing office in some place like Kuala Lumpur, then you would go and you would set up a local Malaysian entity to hire the remainder of those. We'll see what happens going forward, but the normal strategy was to use the Labuan entity and then have foreign companies for whatever else. Right now, conceivably that still works. We'll see, again, what changes over time. But this being said, this is probably a good realization for countries all over the world that over the next while, the pressure is definitely to raise taxes. Whether they can get it through in the next year or whether it takes them a few years, we have a combination of factors that is happening, right? One is countries are spending more, people are demanding more in terms of benefits, they're getting used to those benefits. At the same time, people are often, the tax base is eroding in various different ways. And so as a result, they're saying, okay, great, let's tax this certain set of people. Let's bring in some extra revenue. And of course, those people are the most enabled people to leave. Okay, so you can see in the US, for example, under the Biden administration, they've proposed all kinds of additional taxes. A bunch of those probably won't pass, is what it's looking like at this stage. But on the other hand, it's just sort of a matter of time in terms of this is the trajectory that we're on. The places, on the other hand, that really are creating a lot of opportunities are typically small places, and we're seeing 2 types of carve-outs. So this long term is probably going to be beneficial for Malaysia as well, but we'll see. The first carve-out is things like these digital nomad visas, right? Small countries that are attracting people saying, hey, we're going to make it welcoming for these because they're doing an analysis. And the analysis is the smart analysis that countries should do, but they don't, which is, well, what's the marginal cost to add 1 more person to the system? If we don't have to provide them with healthcare, we don't have to provide them with education, et cetera, we're already providing, policing, roads, et cetera. It's very little marginal cost. So if somebody comes and they spend a lot of money in the economy, they create some jobs, they create some taxes through those people, plus on top of this, they pay VAT, et cetera. Hey, that's a pretty good exchange. We're happy to welcome them. We've seen so many countries open up to digital nomad visas over the last year. So that's going to be a trend that will grow. The second trend that will likely grow is a little bit of what Italy and Greece have done, which is they've created these carve-outs for a certain group of people, right? They say, hey, if you're going to come here, you can pay a flat lump sum tax of 100,000 euros, or you're a pensioner, you can pay this low tax, or and they create some special regime to attract people to come and live there who they can kind of rationalize. It's like, well, they're contributing a bunch, and often there's an expiration period or something like that. I would expect to see more of that over the next little while. What this means for you is probably this is going to mostly affect small countries. If you think about big countries like the US, China, etc., it's difficult for them to do these things because the marginal benefit that they get of bringing in, some wealthy person is minimal. Whereas if you're a small country, if you're Malta, if you're Cyprus, if you're, some other little island or some other small country, Switzerland even, can make a big difference. So that's what I have to say for you today. If you have any questions, put them in the comments below. I'd love to hear from you guys about what you think will happen, what places are likely to be welcoming, etc. I'm here in UAE today, and UAE is a great example of a place that's very welcoming. So yeah, we will look forward to seeing you on the next video.